What's up, guys? So in this video, I'm just going to be going over what are fair value gaps. It's a very simple concept, and a lot of my trading personally are based around fair value gaps and the respect and disrespect of them and of certain ones. So, without going too far into that, let's just kind of dive straight into what they are. So, a fair value gap is essentially a stronger force of orders in one direction in the market. So let's say in a bullish market, we create a bullish fair value gap. What this essentially means is that there is a lot more buying pressure and buying orders within the market at the time of this being created. If there wasn't a lot more buying pressure, or there was equal pressure between buyers and sellers, we will not create a fair value gap. Now, what this will look like is something like this. Something where we are in a balanced market will have wicks connecting these candles on both sides, right? So we can clearly see within these candles, there is no gap, right? Compared to over here, these wicks of these candles are not overlapping each other. It left a gap where there is nothing to the left of this middle candle and there is nothing to the right of this middle candle within this specific range. So this is what a fair value gap is. So without going into all of the extra terms and terminology that people say about fair value gaps, saying, for example, that it is a buy side inefficiency, sell side imbalance, or all of those extra words, the way that I want you to look at fair value gaps is in a bullish market. If we are creating a bullish fair value gap, we are going to always expect that to hold price to the upside. Because if we are in a bullish market and we are having a bullish PD array, and a PD array meaning a fair value gap, a old high or low, a order block, just any confluence towards a trade that you use, we would expect, if we're in a bullish market and we create a bullish fair value gap, we're going to expect that to hold price to the upside, and we're going to expect price to go up. It won't always do that, but if we are in bullish conditions, and it's what we are looking for in price, it is what we would expect to see. We would expect to see a bullish fair value gap hold bullish and send price to the upside. Now, the same way for a bearish market, if we are in a bearish market or we're selling off and we create a big imbalance or a big gap within these candles, which is a fair value gap, meaning that the selling pressure was stronger than buying pressure within this point that this was formed at, we would expect, if we're inside of a bearish market, we would expect to retrace to this bearish fair value gap and send price to the downside. Because any bearish PD array in a bearish market is going to be something that you would expect to send price lower. And not to confuse you with the word PD array, I don't want that to be a confusing thing. It'll be a term that is covered within this program. It just means essentially like a confluence. So a PD array, you could just say, is a confluence. If you have a bunch of confluences towards your trade, say you have 3 confluences, you can have 3 PD arrays towards your trade. But for the sake of simplicity, I'll call it just a confluence from right now. So if we're in a bearish market and we have a bearish confluence, meaning a bearish fair value gap, we would expect it to send price lower. Now, like I said at the start, when we are in a balanced market, meaning that buyers and sellers are both equally strength and they have, relative equal strength, we will not see these fair value gaps being formed. For example, right here, these wicks are overlapping each other, meaning there's no gap within this candle. There's always something to the right or to the left within this candle somewhere. Now, if I changed these wicks and I put them like that, now we have this gap because there's nothing to the left of this candle right here, and there's nothing to the right of this candle right here. There's nothing to the left of this candle, and there's nothing to the right of this candle. So this middle candle is going to be the fair value gap right here. Same way that I showed it over here. So now that I've showed you, some visual examples, now I'll kind of go on the chart and actually show you examples from the chart actually moving. So let's say we just start from the top of price right here. If we are in a bullish market, right, and we are creating these bullish fair value gaps, for example, we have a bullish fair value gap right here because we have this gap within price. There's nothing to the left, nothing to the right, nothing to the left, nothing to the right. We have that bullish fair value gap. We also have this bullish fair value gap and this one. Now, mind you, not all of these are always going to get respected. Sometimes we will disrespect one and then we will respect another. For example, right here, we didn't have a lot of buying pressure coming from this fair value gap. But then when we retraced into this fair value gap, we then continued and send price higher. Now, if we look, actually, yeah, if we just look right here, this move down right here, and this move back up, also including this candle, there was no gap formed within these candles. There's always something to the left or the right of this middle candle right here. There's this wick all the way over to the right, and, you know, over to the left there's nothing, but there is to the right. So that means that this is not a fair value gap. But then when we see price come down here, right, and we have this big sell-off, we can see within to right here on this candle to right here on this candle, on the left and the right side of this candle, there's nothing. It's like a void. So this is a bearish fair value gap. The same way that since we have nothing to the left and the right on these candles, these are bullish fair value gaps. And like I said, you can clearly see price disrespected these fair value gaps. We came past them. We did not have any bullish or buying pressure from these fair value gaps. But with the concept and point, if you're in a bullish market, we would expect them to hold price to the upside. And if you're in a bearish market, we would expect price to hold them to the downside. But right here, this would be a perfect example of them not holding. Right here, we come up and we disrespect this bearish fair value gap. We come up, we close right back above it. That means that it is invalidated. When a fair value gap is closed past, that means that it is invalidated. A fair value gap can wick past it, meaning let's say that second candle that you saw did not form yet. It is okay for price to come above this fair value gap as long as we don't close with a candle above it. So if we're looking at a daily, I'm on the daily time frame, if we're looking at a daily bearish fair value gap, this is still completely valid until we close above it with a daily candle. So if we go to the next candle, we can see this next candle closed above it. So now this is what we will call an inverse fair value gap. And now I'm going to cover this in a separate video, but now since we did not hold this to the downside and we did not reject it and send price to the downside, we could now expect price to go to the upside because we are disrespecting the bearish fair value gaps. And like I said, if we are in a bearish market, we would expect it to send price to the downside. And if you actually do look a little bit closer within price, let's just look right here, right? So these candles form the fair value gap, right? And then this next daily candle, we retraced back up into this daily fair value gap right there between these candles. And then we sold off and we had a rejection. And if I just keep letting price play, we had this daily candle to the downside. So it was respected at one point, but now it is being disrespected. So like I said, once it's closed above, that is what makes it invalid. Not wicking above it, closing above it. That is what makes it invalid. So in terms of fair value gaps, that's really, I think, that all I have to cover within this. It's very simple, and you're going to see a lot of them. They appear everywhere within the market. And just essentially drill it within your head that if you are in a bearish market, you want bearish fair value gaps to send price to the downside. And if you're in a bullish market, you are expecting bullish fair value gaps to hold to the upside. Same way if you have a long bias, it would be the same thing. If you had a short bias, same thing. It's all very simple, and yeah, I hope that helped.